Vivek Rajpal, rate strategist at Nomura India, now joins in on the show. Vivek, what's your sense of the kind of data that we gotten over the weekend with respect to the imports and export figures which have declined in the first quarter of FY13?
Yes, so looks like the current account has come down. Of course, it didn't come down as much as we expected. So, however, the good part was that the BOP was marginally positive. Having said that, this was quarter two. Overall, we think things have improved, and going into the year end, we remain quite positive on the rupee.
Vivek, the fact that markets are now pretty certain that Reserve Bank of India will do some action in the October credit policy, is it still a good time to buy the short end of the yield or short end of the yield curve, assuming that if we get a rate cut, that's one component of the yield curve which will spike the fastest?
I would say market has increased the probability of rate cut or any monetary easing, but it is still not certain. So for those who believe that there will be a rate cut, it makes sense to stay with the shorter end of the yield curve. I think whether they do a explicit rate cut or not, my sense is we will see easing in at least in terms of language, or we will see some kind of assurance in terms of RBI confirming to the markets that they will continue to support markets through liquidity or some other measures.
Vivek, what is your understanding of the macro data which came over the weekend? When I say macro data, the balance of payment data. For the first time after many quarters, we have a surplus, and one is getting a sense that now that gold imports have come down, the balance of payment picture is looking strong.
I would say it has improved, but and it is expected to improve in next 2 quarters, probably next 3 quarters. However, we still remain very vulnerable to the external, to the portfolio flows, to the external environment, to the global environment. So yes, it has improved. It is expected to further improve, which can put the appreciation pressure on which can put the rupee in appreciation mode. However, one should be little careful in extrapolating this data for the medium term. So
Vivek,
that's our house view.
Sure. Let's focus in on the currency also. You've got the rupee, which is off those 5-month highs of 52.5 that it hit on Friday. But what's your sense as to the crucial levels that one should watch out for, and when do you believe the RBI is going to intervene?
So our view is that 52 is a fair value zone, and of course markets can overshoot. So we can see levels below 52. That's where the rupee should stabilize. Now, as far as RBI intervention in terms of building up of reserves from RBI is concerned, it looks like RBI should not be in too much of a hurry, because the rupee appreciation in itself kind of helps bringing the macro dynamics and control. So, for example, rupee appreciation can help in bringing down inflation. So RBI should not. Our sense is RBI will not be in a too much hurry to build FX reserves. Maybe levels around 50, if it goes there, should be the levels where RBI will start thinking on those lines.
Right. So final question. If you look at the total portfolio activity for Indian markets this year, foreign institutional investors have pumped in about $15 billion. So in the light of global liquidity, do you think it will be difficult to put a base number to the rupee?
Base number to the rupee as in, no, in fact we think that around 52, 51, 50, 52 levels we should see some stabilization. Our house view is that we will see this continuation of risk-on phase over the next month or so. However, beyond that, we are not very certain, because till elections in US we are certain, but beyond that we are not certain. We think European issues may come back again to the fore. Then there's a fiscal cliff. So yes, we are positive over the next month or so, or probably a couple of months, but
Sure.
beyond that we remain skeptical.